Labor is one of the primary elements of production cost and represents the remuneration paid to employees for their contribution to organizational activities. In management accounting, labor costs must be accurately measured, classified, recorded, and analyzed to support product costing, budgeting, performance evaluation, and operational control. Since labor expenditure often constitutes a significant proportion of total manufacturing and service costs, effective labor accounting enables management to improve productivity, control costs, and optimize resource utilization while supporting strategic decision-making. A fundamental distinction in labor accounting is between direct labor costs and indirect labor costs. Direct labor consists of wages and salaries paid to employees directly engaged in producing goods or providing services, where their efforts can be specifically traced to individual cost units. Examples include assembly line workers, machine operators, builders, and production technicians. Direct labor forms part of the prime cost of production and is charged directly to work-in-progress accounts. In contrast, indirect labor consists of employees whose services support production, but cannot be directly attributed to individual products or services. Examples include factory supervisors, maintenance personnel, quality inspectors, storekeepers, cleaners, and security staff. Indirect labor forms part of manufacturing overheads and is allocated or apportioned to production through overhead absorption methods. In addition to basic wages, indirect labor costs may include overtime premiums, shift allowances, idle time, sick pay, holiday pay, pension contributions, and employer social security costs, where these cannot be directly assigned to production output. Accurate labor costing depends upon effective systems for capturing and recording labor effort. Organizations commonly employ clock cards, time recording systems, electronic attendance systems, biometric identification, and computerized payroll systems to monitor employee attendance and working hours. In manufacturing environments, job cards, timesheets, and operation tickets record the time employees spend on specific production activities or cost units. Modern organizations increasingly utilize automated barcode systems, RFID technology, biometric scanners, and enterprise resource planning (ERP) systems to collect labor data in real time, improving accuracy while reducing administrative costs and opportunities for fraud. Labor accounting requires appropriate journal and ledger entries to record labor costs and allocate them correctly. When wages are incurred, the labor account is debited in cash or payroll liabilities are credited. Direct labor costs are subsequently transferred by crediting the labor account and debiting the work in progress WIP account, reflecting their direct contribution to production. Indirect labor costs are transferred from the labor account to the production overhead account, where they are accumulated with other indirect manufacturing costs before overhead absorption. The labor account therefore acts as an intermediate control account that analyzes total labor costs into direct and indirect components, ensuring accurate product costing and financial reporting. Organizations adopt different remuneration methods depending upon production processes, motivational objectives, and operational requirements. Under time-based remuneration systems, employees receive payment according to hours worked regardless of output produced. This method provides income stability, supports quality-focused production, and is appropriate where work cannot easily be measured individually. However, it may provide limited incentives for improving productivity. Under piecework systems, employees are paid according to the quantity of output produced, encouraging higher productivity and efficient use of working time. Piece rate systems are particularly suitable for repetitive manufacturing operations where output can be measured objectively. Nevertheless, excessive emphasis on quantity may reduce product quality or encourage unsafe working practices if appropriate controls are absent. Many organizations supplement basic remuneration through individual and group incentive schemes designed to improve motivation and productivity. Individual incentive plans reward employees for exceeding production targets, reducing waste, or improving quality through bonus payments or performance-related pay. Group incentive schemes reward teams collectively, encouraging cooperation, knowledge sharing, and coordinated performance, where production depends upon teamwork rather than individual effort. Effective incentive systems should balance productivity improvements with quality standards and organizational objectives. An important indicator of workforce stability is labor turnover, representing the proportion of employees leaving the organization during a specified period. Labor turnover is calculated as high labor turnover generates significant costs through recruitment, selection, induction, training, reduced productivity, overtime payments, and disruption to operational continuity. Common causes include inadequate remuneration, poor working conditions, limited career opportunities, ineffective supervision, job dissatisfaction, and competitive labor markets. Management accountants therefore monitor turnover rates as important performance indicators supporting human resource planning and cost control. Management accounting also employs labor performance ratios to evaluate operational efficiency. The labor efficiency ratio measures the relationship between standard hours for actual production and actual hours worked. A ratio exceeding 100% indicates greater than expected efficiency. The capacity ratio measures actual hours worked relative to budgeted hours. It evaluates the extent to which available labor capacity has been utilized. The production volume activity ratio compares standard hours for actual output with budgeted hours. This ratio measures overall production achievement relative to planned activity and combines both efficiency and capacity effects. Finally, the labor account provides valuable management information regarding total labor expenditure and its allocation between direct and indirect costs. Debit entries record total labor costs incurred, while credit entries transfer direct labor to work in progress and indirect labor to production overheads. The account enables management to monitor labor utilization, analyze cost structures, control payroll expenditure, and evaluate workforce performance. Consequently, effective labor accounting supports accurate product costing, operational efficiency, strategic planning, and continuous organizational performance improvement.